As of Tuesday, the Fed did something it hadn't done in about 10 years, and that was to intervene in the overnight lending market, or otherwise known as the repo market. Repo is a term which is short around the street for repurchase agreement. Basically, I have something in my possession, you agree to buy it from me, I agree to buy it back from you, generally in a specific time, usually overnight. And effectively, there's a loan embedded in that. And so it's a way that banks use to finance their positions. You may not realize it, but banks trade on margin all the time, just like you might. Except that banks have access to sources of liquidity that you don't, and that's specifically the Fed window, and being backstopped by the Federal Reserve to a certain extent, which you as an individual investor or institutional investor don't enjoy that privilege. But that gives them a funding advantage, and they're regulated entities. What happened was this rate usually tracks somewhere right in the Fed funds target rate. Let's call it 210 with rates being between 2 and 2.25. But what happened was the rate started to spike. I've seen anecdotal evidence that it was as high as 10% overnight. That's completely out of line with what we're seeing in the broader market, and certainly nowhere close to the Fed target. They blame it on three different features. They say there was a large number of corporate tax payments that went out. I've seen an explanation that there were just specific funding needs around this time regarding the Treasury auctions. But the one that sticks with me is that the banks simply were long a lot of treasuries. And that really does follow through. When you think about how yields spiked higher over the past couple of weeks, it would be logical to think that certain banks, or many banks, got caught with a lot more inventory than they would normally want to carry on their books. With a shortage of deposits, which remember they use your deposits to fund their balance sheet, with a shortage of deposits and an excess of positions on their book, that could cause a funding crisis. The interesting thing to me was that the funding crisis was $53 billion. Yes, that's the number that the banks borrowed at this special repo window. That's a lot of money. And it really makes you wonder what's going on under the surface. We've seen very placid equity markets, but there have been big moves in bonds. There's been big changes to the shape of the yield curve. There have been big moves let's say, in terms of momentum versus value. Yet along the surface, in terms of the major indices like the S&P and the NASDAQ, it's been fairly placid. I start to worry when I see events like this going on that just seem way out of the market's normal purview. I'm not going to worry too much about it. It's not unheard of to have temporary funding crises like these. They often happen at the end of a quarter, but that being said, we're only 2 weeks away from the end of a quarter. And particularly the end of the year, you see some crazy financing hijinks, basically as everybody's trying to square up their books for the year end. So I'm not going to worry about this too much on a one-day basis. It could just be a one-off. And actually, until the Fed really expanded its balance sheet, the Fed would really be intervening on a routine basis. So it's not unheard of for the Fed to be doing this. But when something strange comes out of the blue and the market really doesn't react to it, I get concerned. And this would be something that I would be keeping an eye on to see whether these stresses are temporary or more ongoing. If they're more ongoing, I think it's very opportune to be lowering your risk profile because these things can end in very unexpected ways. If it's one and done, well, let's carry on, I guess.